Today's guest is Peter Hug, who is an expert in the gold and precious metals market. We're going to explore how gold can be part of your wealth strategy and how it differs from Bitcoin. Welcome to Richer Soul, Life Beyond Money, the last baby step. Imagine it's 12 months from now. You've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? What's it like to have great relationships, friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want, to be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time. Your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. I help people live the life of their dreams and bring balance to health, wealth, relationships, time, and spirituality. You can learn how by listening to the framework in episodes 1 through 9. It's simpler than you can imagine. You can also hear actual coaching calls by looking under the coaching call tab on richersoul.com. You'll also find all the show notes for this episode there, and there's a link in this episode. I send out a monthly email, and you can sign up while you're there. In the monthly email, I share the best articles I read this month, let you know about upcoming episodes, and share a little wisdom. I also share the most interesting articles I read on Facebook at facebook.com/richersoul. Today, I want to focus on relationships and the power of coffee meetings. I grew up with this attitude that building relationships was somewhat of cheating. It wasn't fair to use a network to get ahead. That's not true. You have to build and leverage your network. They can help you in all areas of life. Your network power doesn't come from the people closest to you, but in the people in your outer circle. Too often we think that VIPs or people at the top levels of companies don't want to talk to us. That's not true at all. Most successful people are looking for other successful people. They want to help create success as well. The problem is, so few people take action. That is why when you try to connect and do it in an unselfish way without looking for an immediate return, you can achieve success in your network building. This means that you need to give before you ask, and to give a lot. You also need to connect before you need help. For example, my kids, I had them connect with colleges in 10th grade versus in 12th grade, because in 10th grade, they had the ability to learn without the expectation that they were trying to get into that school at that moment. The same applies in the job market. When you learn about careers, companies, and jobs, when you're not interested, it removes the pressure from the situation. And people are much more willing to be honest with you. The coffee meeting is an excellent way to build relationships and to connect with others. You can reach out to people to learn their story and also about a particular topic you're interested in. I found these to be great relationship builders, and I tend to talk about 10 to 20% of the time and spend the rest listening to the other person's story and advice. That means I'm quiet 80 to 90% of the time, which for some people might be uncomfortable. Let's face it, everyone wants to tell you what to do. If you work in a company, you can have coffee meetings with the department heads and VPs of other areas than the ones you work in. This allows you to build exposure across the company. Volunteering with charities also allows you to have access to people you may not normally come in contact with. Let's face it, charities have some very big donors, and those donors like people who support their causes. Again, with everything in life, be intentional with who you want to connect with and take the time to do so. It needs to be part of your calendar. It's not going to happen overnight, but when you take the time, you can create some amazing relationships well beyond what you think is possible. In today's episode, I wanted to learn more about the current gold market as an investment, and now I get the opportunity to have an expert on, and I'm grateful I can share it with you. This is an advanced strategy and should only be pursued once you have a strong foundation or the market creates an opportunity. Back in the late 90s, gold was cheap, and so I saw an opportunity. But rather than buying coins that sit somewhere locked up, I bought my wife 22K gold jewelry. Now normally, this is a horrible plan because the markup on the jewelry can almost never be overcome. However, Indian jewelry that's machine-made sells at a very small markup. At that time, it was about $40 an ounce over the cost of gold. And because it was 22 karat versus 24 karat, there was also a small difference there. However, I had both the utility of the gold and my wife enjoying the investment benefit. Today, gold is trading much higher, and inflation is a concern. I want to revisit gold as a strategy. Listen in as I do. Peter Hugg is the Director of Global Trade for Kitco Metals Inc. Peter has been involved in the precious metals industry since 1974. He speaks to thousands of viewers each week on Kitco News, drawing on years of frontline experience to provide a trader's perspective on the market. Mr. Hugg contributes daily commentary and market insights for the millions of readers visiting kitco.com each month. A frequent speaker at precious metals conferences and in the financial media, Peter is one of a handful of experts who have succeeded through multiple bull and bear cycles using skills honed during the dramatic fluctuations of the 1980s. Prior to joining Kitco, Mr. Hugg served as Senior Vice President at Guardian Trust Company, now a part of Laurentian Bank, which became one of the largest international trading houses for precious metals. Mr. Hugg developed the first precious metals certificate program and the first margin trading accounts for metals on the cash market. This show was recorded on June 19th, so the prices are not current to today. Let's meet Peter. Welcome to Richer Soul, Peter. It's great to have you join us today.
It's a pleasure to be here, Rocky.
It's an honor to have you. So we always start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
Well, I can give you the immigrant story. My dad came over from Germany in 1951. He was a trained chef out of Switzerland, but based on the time, there was no employment in Europe, and he immigrated to Canada. The old story of the $6 in his pocket, and the first place he went was a haircut, which cost him $3. And he sort of got himself a job, and after about a year, he sent for my mother and I came to Canada when I was 2 years old in 54. And my joke to my kids was I had jeans with holes in them long before they were fashionable. And, we had a relatively lower middle class life. There was always food on the table. There was always a roof over my head. My parents got along, which was cool, and also brought a sister into the equation about 6 years later. So, yeah, our family life was great. We, again, didn't have a lot of money, so it was sort of becoming somewhat streetwise in the sense that I started looking for work when I was 13 years old, just even part-time, cutting grass. Again, the standard story, it's millions of people out there have a similar story. And I worked my way up through high school in Canada. After grade 10, the high school I went to had a tuition, so I needed a job in the summer to pay for the tuition. I was fortunate enough to get into university, worked 2 jobs while I was in university to pay for university, graduated university, and graduated with the full intent of becoming a teacher. At that time in Canada, 73, there were virtually no teaching positions anywhere in Canada. So I was looking for employment, and a friend of mine said, why don't you consider trading in foreign exchange? And again, I had no clue what he was talking about, and I asked him more questions. And he was a an assistant vice president for the largest retail foreign exchange company in the world at that time called Deke Pereira. Subsequently, they were bought about 15 years later by Thomas Cook, which is the traveler check company that most people associate that name with. So anyway, I started at the teller level, worked my way up, got into the trading room about a month in, and just by happenstance actually, there were 4 traders in there, and a month later, 2 of them had moved back to Switzerland. One lady got pregnant and the other one quit. And I found myself being the chief dealer for the largest foreign exchange company in the world for their Canadian operation. So I did that for about 3 years. Then I was approached by a financial institution called Guardian Trust that were Quebec-based at the time, and that was just when Canada was going through its referendum process. And they decided that it would be wise for them to have a branch outside of the province, and they set one up in Ontario, where I was. And I was asked to join the company to develop a foreign exchange business for them, but also to look at the possibility of introducing precious metals into their product mix. So I was with them. I joined them in 76. I left Guardian in 91 when they were sold to a French bank. My kids were still small, so I didn't want to move to Quebec. And then I went to work for a mega giant in the industry. Today they're called Scotia Makata. Back then they were just the Bank of Nova Scotia. I worked for them for about 9 months before I just realized, based on my personality and my past track record, that I just couldn't work for a bank. It was the decision-making process. Everything was just much too slow for what I was used to. So I left the industry in 92 and was hired as the CEO of a public company that did microchip identification for pets in Canada. The company was struggling. One of the major shareholders asked me if I could run the company and turn it around. So I got into pet identification. It is now basically an accepted practice everywhere in North America. Every vet microchips animals, all shelters scan and microchip animals. And public company did very well once we got established. And I left the company in 97. And at that point, I was offered a position in the Bahamas. I went down there for 2 years. Came back then in the early 2000s. I went over to New Zealand for a year, traded for a metals company over there. In between 90 and 2000, I also had a consulting company and I set up 2 retail foreign exchange dealers in Canada. One just got sold for $350 million. So then I retired. I basically set up a country inn in Niagara-on-the-Lake, which is about 10 miles from Niagara Falls on the Canadian side, and did a little bit of trading for some proprietary clients while I was doing that, and was prepared to just sort of retire in the wine country of Canada. And then I got a call from Kitco in 2009, and they had grown from a contingent of 10 personnel to well over 220. The owner, who happened to be a client of mine way back in the day when I was running the trading desk for the bank, remembered me and knew me and asked me if I wanted to run his precious metals division. So I took the job in 2010 and still there now. So that's sort of the time-lapse capsule.
Suffice to say, you have quite a background in precious metals and you're an expert in that area. And we're going to dig into that in a little bit. Just before we do, just a side question. And we always ask, you've got kids. Have you done anything different to teach your kids about money?
Well, unfortunately, I probably did not get the same practical lesson that I got as a kid because I was considerably more affluent than my parents. And as a result of that affluence, I would imagine on a comparison basis, I spoiled my kids much more than obviously my parents spoiled me. Not that they probably would not have wanted to, they just were not capable of doing it. So in that context, I do regret some of the sort of flamboyancy that I expressed towards my children was when they were growing up. But now as they're adults, something's worked out. All 3 of them are fully educated. They've all got good jobs. One is possibly thinking of settling down. So in that context, they all seem to have turned out to be reasonably well-balanced human beings. From an investment perspective, the primary lesson that I tell my kids is the same thing I'll tell my friends or I'll tell a complete stranger if they ask me the question. What is the absolute smartest principle when it comes to investing. And, and this is a lesson I learned the hard way, but it really is a lesson that you need to understand, and you need to be able to exercise. And that's, you cut your losses and you let your profits run. And I know that sounds simple, but what happens is, and again, I've had a lot of anecdotes about this, but let's say you buy, I'm just going to use the word Apple, but Apple's a bad example because it's obviously had a stellar performance. But let's say you buy Apple at $20 a share because either, and most likely you haven't done your homework or your research, you've heard it from your neighbor or your postman that he's bought this Apple. So anyway, you jump in and you buy Apple at $20. Mentally, when you do that, if you don't fully understand the dynamics, or at least the amount of risk you're prepared to take, is you need to set a stop. So if you bought it at 20, the stop might be $17. And when it gets to 17, what investors tend to do is they tend to say, well, it's gone to 17, it can't go much lower. And they'll hold. A Jewish broker once told me, he says, the worst thing that happened to my people other than the war is, and he said to me, he said, is what? And I said, I have no idea. He said, is averaging down. And what he said to me was that if the stock is a bad stock at 20, it's not a better stock at 17. So you've got to be prepared to take your loss. Vice versa, if you bought the stock at 20 and, whether you did your research or somebody gave you a good a tip or whatever, and it's at 24, you want to run your profit, but you want to protect it. So you maybe raise your stop to 22. So that way, if the market corrects back, you've at least got a 10% gain in your trade. If the market goes to 27, you raise your stop from 22 to 24 and you trail the market up. But that way, when the correction comes, and inevitably it will, no matter what the investment is, you're at least going to lock in your profit as it's running higher. So that is, I think, one lesson that's really important. And the second lesson that I've told them is you absolutely have to keep emotion out of anything you do when it relates to money. It's got to be absolute cold as ice. You cannot wish something or hope for something. You've got to take all that emotion out, and you've got to, it's almost like playing chess. You make your move. It's a strategic move. If you're wrong, you got to cut your losses, or you lose the game. And so that's basically what I tell my kids. I'm not sure if that's answered your question.
It is a wonderful answer, and it's quite a wise answer, I think. A couple of years ago, I was in a stock club, and one of the things that we started doing in the stock club was to set a trailing stop loss order. And I think we would set it at, I forget the number, but it was like 15%. And it was automated. So we would buy a stock, and the stop loss would be trailing 15%. And if the stock fell, like you said, from 20 to 17, it would automatically trigger the sale. But on the upside, if it started running up, we would just let it run. But let's say it got to 30 and then it dropped down from 30, it dropped down to about what would be 26 and a half. It automatically triggered the stop loss.
Right. So you carried your trailing on the way up as well as for downside protection.
For downside protection. And a lot of times the stock got sold and some people would be upset like, oh, it got sold. But the reality is when we look back historically, it saved us from a ton of losses. And I think that's what Warren Buffett says. Rule number 1, never lose money. Rule number 2, look at rule number 1. And I think in the investment business, if you can protect your downside and not make big mistakes, that is a very important part of building wealth over time. So I think that is very true. And then the mindsets of being emotionally unattached. I've made a tremendous amount of emotional mistakes in stock trading, and I've admitted them before. Clearly, stepping away makes a lot of sense. And now, like I know in my real estate business, it's not emotional at all. We're very clear cut, and it has served us quite well. So 2 excellent pieces of advice. You have spent a tremendous amount of time in the precious metal industry, and I would like to talk a little bit about gold. Maybe kind of start with the history of gold, because I don't know if a lot of younger people even realize that not that long ago, it was illegal to buy gold in the United States. So I think you got in right after that became legal. Is that correct?
That's correct, yeah. Instead of using the word legalized, it began to float freely versus the dollar in 73. There was a treaty after World War II, which was called the Bretton Woods Agreement, which basically locked currency values based on the gold reserves of any country whose currency was going to be a primary trading currency, U.S. dollar obviously being the global currency, which it still is today from an exchange perspective. What happened in the late 60s was that the U.S. economy was in trouble because of the budget deficits associated with the Vietnam War. The U.S. dollar started to lose value relative a basket of currencies on a global basis. So obviously a weaker dollar would create a higher import costs. So it was considered a negative to have that dollar weaken. But what people were doing were they were exchanging the dollar as it got weaker for gold, because that was the monetary method that was open to them for getting value for their dollar. But as the dollar weakened, the U.S. gold reserves dropped considerably, almost to a point of not having any reserves. That's how much repatriation of the dollar took place. So Nixon in 73 ended the Bretton Woods Agreement, and gold started to float freely against the U.S. dollar in 73. So it started at $35 an ounce, pretty much immediately went up into the low 50s, and then sort of hung around that level until about 76. And when I joined Guardian in 76 and we started to trade gold, the gold price in Canadian dollar terms was still under $100, because the Canadian dollar in 76 prior to the referendum was actually at a premium to the U.S. dollar. But that was the lowest I saw gold from a trader's perspective, was about 98 Canadian dollars, or in U.S. terms at the time about 102, 103. Then we had the oil shock in the late 70s, and inflation started to take off. Inflation back in 79, early 80 was at 18%. Interest rates were at 15%. I remember a broker calling me back in 79, telling me, late 79, telling me to buy a a Canadian strip bond. And I said, so what's a strip bond? How does that work? And he said, well, if you invest $5,000 today, so this was 79, it came due, and it was 25, I think it was a 25-year, might have been a 30-year strip. He said in 30 years, this $5,000 is going to be equal to $62,500, because the interest rate it's paying is being stripped, and the interest rate currently is 15%. So if you had $50,000 back then and just put it into a strip bond, you would have returned about almost $3 million back in the early 2000s. But anyway, so gold took off because of the inflation threat. The dollar was collapsing. The Hunt brothers, they say they were responsible for the silver move higher. To some extent they were, but there's a much bigger story behind the Hunt brothers than what's been portrayed in the media. And you had gold reach $850, and you had silver reach $50 for the first time. Now remember, all of this happened when no computers were available. Nobody had iPhones or any type of digital equipment. We were using IBM Selectric typewriters. There weren't even faxes invented then. We were using something called a teletype, almost like a stock checker. It comes out in a long, sort of perforated piece of strip, and then you have to refeed it back into the machine to play your message. That's basically how we operated back then. The only service that provided pricing was Reuters at the time, and that service was notorious for going down at the worst possible times. And so this was all sort of done manually as this gold market exploded. And then the U.S. The Fed aggressively raised interest rates and knocked inflation back down. And we went into a recession in 82 that caused the metals markets to start to move lower as people liquidated to raise cash. And gold dropped from $850 down to a low of just under 300, and traded between 300 and 600 between 82 and 92. And then between 92 and 02, the gold market did virtually nothing. It stayed in a $50, $60 range for most of that decade. And then in 02, 03, it started to garner some interest, moved up into the low 400s. And then as the financial situation started to deteriorate in the United States and people were starting to get worried, gold moved up to about $800 an ounce and then took off right after the financial crisis of 2008. Hit a high at 2011 at 1930, roughly 30, it was 1927 and change. Silver hit $50 one more time. And then gold hit a low in 2010 of 1,040. And between 2010 and today, gold has gone from 1,040 as high as 1,365 four times, and now rests at 1,278.
And I think that gives a good history of why people look at gold as an inflation hedge and as, I guess, a protection type of a thing when things are not going well. And that makes a lot of sense for the way people behave with gold. What has been your experience as to why people buy gold? I know you talk about there's different types of gold buyers.
Yeah, I mean, it's a question again. The irony of it is when I've given some speeches at conferences, sometimes I take the nostalgia trip or train backwards and look at what we had then from an offering perspective to investors and, what we have today. And quite frankly, other than ETFs and some esoteric vehicles like trading the gold-silver ratio on the exchanges, there is very little different today than there was back in 79. I mean, back in 79, you could buy physical gold, you could buy gold mining shares, you could invest in mutual funds that invested in gold. You could, what you didn't have were the ETFs. But you had storage accounts, you had trading accounts in gold, you had companies offering leveraged products in gold where you would only put down 20% and they, on a cash market now, we're not talking a futures exchange, and you could control, with $20 down, you could control $100 worth of gold or silver. There were futures, there were options. But 95% of the vehicles that are available in today's market were available in 79. So, when you look at that, and then the questions that I was asked then are similar to questions I get asked today, but I have to tell you, they're not as frequent. And if you remind me on this point, there is a demographic shift that has occurred since then that I think is relevant. But today, people will still ask me, should I buy gold? And, I'm not one of these guys standing on a mountain saying gold's going to $20,000 an ounce. The world's coming to an end. There's enough pundits out there and talking heads that will present that point of view. I'm not suggesting it's not possible, but I'm just not one of those proponents that tries to encourage somebody to make an investment by scaring them. It should be, again, a rational decision as to why you're buying gold. And to make that decision, you need to ask yourself why you're buying it. Now, if you're buying it for capital gains perspective, meaning you want to trade it, it's as dangerous trading gold as it is trading oil or soybeans. If you're a trader, you need to be in a space where you can actually trade it, and that is not the physical market, because you have to pay sometimes substantial spreads between bid offer on physical, and as a trader you have to overcome that to make your capital gain. So as a trader, you're going to want to be on the futures market and or in the options market. So you have the leverage and you have the flexibility of getting in and out of the market at very tight spreads. So if that's your purpose, you can trade gold whenever. It's not a good or a bad time. I mean, by the concept, the word trading, the concept implies that you might also be short, not just long. So, at times you may be bullish, at times you may be bearish. Again, it's a lot of work. You need to understand the market, and you've got to stay on top of it because you're leveraged. So, that's sort of what I tell people that want to trade. And they'll say, well, is this a good time to buy? And I says, well, look, I mean, it's as good a time to sell as it is a good time to buy if you're a trader. It depends where the technical levels are, some of the fundamentals that are setting up. I mean, we were very negative this gold market 2 weeks ago when it could not clear up through 1307 from a trader's perspective. It tried twice. We said that's technical resistance. We need to see it get through that level to generate any momentum. And it bounced off it 3 times. And then after last Wednesday's Fed announcement and the ECB's announcement on Thursday, the market just tanked. So again, as a trader being short up there, you've picked up $30. That's a nice trade on gold, a 100-ounce contract. That's $3,000 per contract. Now, if you are an investor, there are, again, 2 types of investors. There's one that honestly believes that the financial system is going to collapse and that the U.S. government may make it illegal again to own gold, and that you're going to need gold as a basis for barter, when this financial calamity occurs. Now, for those types of individuals, and again, I'm not arguing that they're right or wrong, but for those mindset individuals, the only option they should be considering is physical gold. Because if they don't trust the system, you can't possibly trust the ETFs. You can't possibly trust mining shares. You can't trust anybody holding your gold for you, because if the system collapses, where does that gold go? So your only alternative, if you're holding gold, is then to buy physical. And you're buying it sort of when the world, when this Armageddon happens. So to you, the price really isn't that relevant, because you will then, in your mind, are believing that in that Armageddon scenario, gold isn't going to be at $1,200. It could very well be at $20,000. So, in that context, you don't care about the price. You're not that price sensitive. And then you sort of have the third group that has heard forever that it's probably practical to hold a small amount of gold in your portfolio as an insurance position. And on that point, I don't argue with the point. I argue that the point has not been fully extrapolated. And by that, I mean, if you we can pick a number, but if you as the investor say, I want 10% of my assets in gold, so that's your plan, 10%. The thing is, you can't just buy the gold and just forget about it. I mean, gold fluctuates, as does your portfolio. So just to give you like a simple math example, had you bought gold in 2008 at, if you got, let's say 800 for a round number. In 2011, gold was at 1925. I mean, your portfolio wouldn't have been holding 10% gold. It was likely holding 20% gold. So in that context, you need to sell. You need to get back down to 10%. And you need to do this calibration at least once every 6 months. Now, vice versa, had you bought at the top in 2011, and then in 2010, gold's sitting down at 1,040, your 10% is probably now worth 4% or maybe 5%. So you need to buy another 5%. Remember, the goal is to hold 10%. But if you calibrate your portfolio, you're likely to add gold to your position when the gold price is lower and sell gold out of your position as the gold price appreciates. So, using those 3 formats, then you ask me the question, is this the right time to buy gold? I think for scenario number 1, yes. I don't think the question applies to scenario number 1, it does not apply to the trader. It does apply for the individual that is concerned about financial collapse. And on the third basis, again, if you're doing it as insurance, then it's not a question of if you're buying insurance, you've got to buy insurance. Sometimes, you'll have house insurance for 20 years. You'll never file a claim. But the year you pull it off will be the year that your roof caves in. So it's that kind of assessment you need to make.
Thank you for sharing that. I remember when I was younger and gold prices were going up, people always said, instead of investing in gold, you invest in the mining companies because you would get a much larger multiple on the upside. And then I remember it when gold had hit the bottoms, people were talking that it was actually below the cost of mining gold. And I haven't kept up. There's still a cost to mining gold. Do we know about what that is per ounce currently, or is that irrelevant?
No, I think there is relevance there. Again, it's if you're looking at an average global production price, the problem there is we don't really know what it costs the Chinese, and they are a pretty significant producer of gold. Although they are still a net importer of gold, they do produce a significant amount of gold, but it's all for internal consumption. But I asked at a conference of all of the major dealers in North America go to this conference, and I spoke to one of, and I don't want to divulge the bank, but I spoke to one of the top economists for one of the gold trading banks, an individual that I respect and I've known for many, many, many years. And he gave a presentation on gold and where the bank saw it going. But I asked him, I said, look, I'm always asked what the current average cost of production for gold is. And again, I'm not a mining guy, so I don't really follow it that closely. He told me it was in the neighborhood of about $880.
Okay. So it's up considerably, because I remember when gold was down below 300 at that point, I think it was late 2000s, they were talking about mining costs being about $300 an ounce.
And I doubt that is true. I mean, if you were talking to Barrick or Newmont, maybe. But I think even Barrick's cost is somewhere around the $6, $7 range. It really depends on what mine you're talking about. But the juniors saying that they can pull gold out at $300, the only way you do that is if the gold's sitting on the top and you're just shoveling it off the ground. I don't see that number that late in like if it's in 2000, I don't see that number being an accurate number. With mining shares, yeah, you're right. If you get lucky, you can make a home run. But, my rule of thumb with junior mining shares, now we're not talking mining companies that are producing and generating cash. We're talking about junior companies, which is 95% of everything you see, if not a higher percentage in the market, that basically have a lease on a property that is adjacent to another property. They have a geologist, could be a well-respected geologist, that has done core samples and says that there is X amount of gold under the ground here. Then they take that information, they go to the banks, or they try to do an IPO, broker gets in behind them, they raise some seed capital, and then they start dropping their first drill hole. But from the time they went to get their money raised to gold actually coming out of the ground on that type of a business is years. Could be 3, 5, could be 7 years before you see production coming out the other side. So what tends to happen is you tend to get people promoting this, and if they really do have something there, then what will usually happen is you'll get a major that comes in and takes them over. Now, out of 100 junior mining shares that get listed tomorrow, I can almost promise you that 90 of them will lose everything within the first year, and they'll literally get delisted. And the other 5 will still be on and hanging on, and maybe the other 5 will actually get to a point of production in 5 to 7 years from now. So I think the odds of hitting a home run are slim. Personally, if you're going to play that game, unless you've got some really good feel or you're very lucky, your odds are better at a blackjack table.
I agree with you. And then thank you for that. I didn't realize that is what the current mining market looks like. And so that's quite helpful in being able to not make the mistake of betting on a bet that you've got a 95% chance of losing on.
Again, that's my personal feeling.
That's fine. Yeah. And so, we can have the disclaimer. This is all just a conversation. You need to go investigate for yourself. Don't go off of what we say. So you mentioned a demographic change, and you also mentioned China. I know China and India are big users of gold for jewelry. Are they still continuing to pull with that demand, or is that also changing?
The psychology behind investment demand in India is not changing. It remains as robust as ever. It's just with the price recently having gone over to 1,300, and they have import duties now, and they're still working through some of those issues. Imports of gold into India are down from last year, same period, but not in a major way. They may be down like 7 to 10%, so nothing major. But there are financial reasons why the demand is lower, and most of it has to do with the import regulations of gold being imported into India. Now, China, they're also obviously a big buyer of jewelry, but they are a big buyer of bullion, and they tend to buy their bullion if they're financially capable of doing this, and it's not difficult to do it, but it's you need to have some financial wherewithal. And they'll buy their physical gold if they're buying bulk, usually stored in Singapore. So they have relationships, and ironically, I don't think the fact that China has 80% of the Bitcoin volume on the global markets should surprise anyone. It's an extremely efficient way for Chinese residents to get their capital out of China. They'll go wherever they need to go, or whatever merchant will sell them product. Especially if you're selling them gold product, they'll convert their Bitcoin to gold. It's usually done fairly efficiently on a gold platform. We offer it as well. I mean, it's just normal course business. And then the Chinese either keep the gold and hold it in Canada, or they sell it for dollars and have the dollars repatriated to a bank that they've set up outside of China. So it does lend itself, Bitcoin does lend itself to the Chinese being able to move money outside of their country. Demand in and of itself, though, the Chinese really like gold. They really like gold much, much more than they like silver, although that's starting to pick up in interest. But they've always been big gold buyers on a retail basis as well. And we have an office in Hong Kong, and we service a lot of these Chinese clients out of our Hong Kong office. So in the demographics I was talking about was more the millennials. And, my dad's generation, except for the few souls that are still out there, is pretty much in the ground. I'm getting up to be 70, so my generation is sort of getting long on the tooth. Baby boomers are retiring at 10,000 a day. So the sort of the old guys that have lived through some issues, lived through the inflation spike in the late 70s, the banking crisis in 87, the S&L collapse in 92, the dot-com bubble in 2000, the issue in 2008. We've lived the experience and realized that holding gold, certainly in times of uncertainty, makes abundant sense. My problem is the group behind us. So my kids are mid-30s, but when the financial crisis hit 10 years ago, they were 25, 24. They didn't have any money to lose. They were just coming out of school. They saw it happen, but it didn't affect them. So a lot of gold buying has been historically people that understand the correlation to when something goes wrong, why gold is good. And I think the biggest feat that the gold market or dealers need to figure out is they've got to figure out how to entice the millennials into this business. And it's happening slowly, but it's happening. But it's not happening for the same reasons that myself or my dad would have bought gold. They like the blockchain. They like the crypto side. So they play one off against each other. And now gold is sort of a sexy thing that's associated also with Bitcoin. So if you can get that message to them, they'll be in, but they will not be long-term holders. These guys will be the traders back and forth. But it will create liquidity and volatility in the markets. But the long-time holder of gold, because of issues or just past experience, is missing from this market. Now, the millennials will feel it one day. One of these days, they're going to have the capital at risk, and they're going to feel the sting. And then they'll be the new wave of long-term holders of gold. But that conversion is a work in progress right now.
I was going to ask you about that, is Bitcoin versus gold, because it seems most of the young people are all hopping on the Bitcoin, gold in a sense has a physical presence, and so it is a limited supply. Bitcoin is kind of just out there, and it's going up and down like crazy. It seems to be versus gold, that although gold does go up and down, it seems to be gold moves for more practical reasons. Bitcoin right now seems to be moving for emotional reasons.
But again, it's one of those investments back in January when it was trading at 19,000, or in December, I think it might have been. Everybody that was on, anybody that they brought on, because they brought on a lot of people on, the CNBC's programs of the world, and these were all cryptocurrency experts, all calling for 50, 60,000, and lo and behold, it dropped actually 60% from the high down to the low of roughly 6,000. Then it bounced back up to 11,000, and then it bounced back down to 7,000. I mean, how do you... My issue with Bitcoin is I can't translate it into something that I can hold here at $6,000 and see a value a year from now that I can back up with something. The fact that the market thinks it's worth 30,000 in a year from now, does that make it worth 30,000? So am I specking on the belief that somebody believes it's going to be worth 30,000? I mean, what makes it worth 30,000? What's the tangible value behind it, other than it's limited on its issuance? So there could be a rush to Bitcoin to buy it because there's limited supply of this. But that to me is not saying you can't make a killing on it, but boy, your timing's got to be dead on this one, in my opinion. Otherwise, you can get whipsawed in a big way in this market.
Very much so. So what tends to affect gold prices today?
Standard stuff, again, that happened in 79. I mean, basically, higher interest rates, which generally translates into a stronger dollar. Generally, a stronger dollar is negative for commodity prices, because you get more units of the commodity for the stronger dollar, so commodity prices drop. You have geopolitical risks. I mean, they now have been somewhat mitigated with the summit in North Korea, although I haven't heard a word since then. And now with the U.S. trade tariffs against China, I was actually surprised Trump went ahead and did that because North Korea, or China, has North Korea's ear, and they could put a kibosh on any summit going forward very quickly, or any type of move towards a peace settlement. So there's a number of geopolitical risks out there. In Europe, some of the Italian banks are at risk. There's a huge populist movement. You're seeing it in the States with Trump. Maybe populist in the U.S. is maybe an exaggeration, but in Europe, the right wing is really gaining strength in all countries. And so there's going to be some social issues over there. So there's a lot of things that are unsettled right now. But what's hurting gold in the short run is the fact that you have interest rates moving higher in the United States, whereas in Europe, and this goes back to last Wednesday when the Fed indicated that they saw another 2 to 4 interest rate increases between now and mid-2019. And the ECB came out the day later, and Draghi said he doesn't see any change in his policy till the end of the year. So now you have interest rate differentials increasing between the US dollar and the Eurozone. And money has no loyalty. It's totally fickle. And, if they see the euro dropping and they see the dollar appreciating, and they can get an extra 3 points on, or 2 points on their money, they're going to buy dollars. So that is perpetuating the dollar strength, which is putting a headwind against gold's move.
So if someone wants to buy gold and hold it, there's a variety of different ways. I mean, clearly an easy way to do it is just to buy an ETF of gold, and then the other is to hold it physically. I've heard a lot of negatives around buying the ETFs of gold, not in normal times, but it seems that there seems to be a hesitation that when there is a financial crisis, that the ETF may implode. And I'm not sure I understand why that is. Is it that the ETFs don't actually own the gold?
That comes down to group number 2, who honestly believes that the ETFs are selling you paper and there's nothing backing up the paper. So the question is, do you trust the system? And the system, if you read the prospectus of the largest gold ETFs that are in the market, they have a custodian bank, usually HSBC, which is probably the world's largest custodial bank for storage of gold, including COMEX, which is the futures market. They have it audited based on, and they're a security, so they're registered by the Securities Commission. Now, if you believe all of these entities are conspiring together and there is no gold and they're just selling a dream, if the world comes to an end and gold explodes and they don't have the gold and they haven't hedged the gold, there's going to be a huge issue. I don't happen to be in that camp.
And that's fine. It's just one of the things that came up because...
But it's a prevalent theory out there, and again, I don't subscribe to it. Doesn't mean I'm correct, though. I could be totally wrong. Now, in a market like an equity market where an ETF trades, if there is major volatility in the markets, it might be that the liquidity on an ETF would not be as good as having physical gold with the dealer or having it yourself, as long as you have access to sell it quickly. So that's one of the downsides for physical. I mean, if somebody's looking to buy physical and they want to hold it with the anticipation of selling it if there's a pop, if you hold it under your mattress, now dealers will make you a market on the basis that you'll ship them that gold. But again, you've got to go through the process of contacting a dealer. You need an account. You've got to ship the gold to the dealer. Some dealers won't pay you until they receive the gold, blah, blah, blah. So your liquidity is gone. Whereas if you hold the gold with a dealer in a segregated safekeeping account where it's off balance sheet from the dealer, so if the dealer were to close overnight, your gold would be totally protected from a balance sheet risk. Then you pick up the phone and say, I've got 10 ounces of gold with you. What's your bid? Boom, you're done. It's sold because the dealer already has the gold.
And in that case, though, you're paying the carrying charge. You're paying them to store it every year.
It's relatively incidental. I mean, you can store gold, you can store 10 ounces of gold at 0.75% per annum. So if you work it out, 10 ounces of gold gives you, so let's say $13,000 worth of gold for a round number. If you're paying carry of 70 bips, it's $91 per year. So divided by 12, you're paying somebody $7 to hold your 10 ounces of gold. Yeah, so every month they hold it, basically your gold depreciates by 75 cents an ounce. Again, it's what your time horizon is. If your time horizon is you want to buy gold, you want to keep it safe, you don't trust anybody. Now, you don't even have to trust anybody, but you want to keep it safe. Ironically, right now, ignore the core gold price, but there is a lot of secondary gold on the market. So picking up physical gold right now, from a premium perspective to the gold price, has never been this low in the history that I've been in this market.
So can you explain that? You mean buying coins or buying bars or buying wafers?
Even buying coins. I'll give you the typical American example. If you are buying this product and you're going to sell it in the United States, great. It's a great product. It's called the Gold American Eagle. It is absolutely the worst coin, however, to buy if you're looking potentially to have international liquidity. In Canada, the coin is heavily discounted because it's a 22-karat coin, so it's taxable. The Chinese will not buy a 22-karat coin. They only want a 4/9 coin. So the Americans came up with a product that is exempt from all these sales taxes and competes directly with the Canadian Maple Leaf, which is the gold buffalo. It trades at exactly the same premium that the Eagle trades at. So you're not paying a premium for 4/9 gold, but you also pick up the international liquidity in case you ever have this gold in your pocket and you travel to another country. It's going to be better received than an American Eagle because of the purity of the coin. That said, when you go to a dealer, you have basically two options. It doesn't matter which coin you pick. Let's pick the American Eagle just for the sake of a coin. The U.S. Mint offers no breaks to anybody. Doesn't matter how big you are or how small you are. If you're a distributor for the U.S. Mint, and you could be a coin dealer, you will pay the same premium for an American Eagle, both gold and silver, that the largest gold trading bank in the world will pay. And on American Gold Eagles, that premium is 3%. So any dealer in the world that wants American Eagles that has a distribution agreement with the U.S. Mint can buy Gold Eagles at 3%. Now, their current dated year is 2018. They are no different in look than the 2017s, 2016s, or 2015s. They look identical. They're the exact same coin, and they're a harder alloy because they're 22 karat. So some clients, they want current dated Eagles. And for that, they will pay a premium. First of all, the dealer pays 3%, which on current market is roughly $36. Then they've got to ship it from San Francisco to their depots, which are usually in New York. So let's say the dealer gets a landed cost in New York at $37. That might be a tad high, but $37. Now he's got to make a market to other smaller dealers. Now he wants to make a markup. So this primary dealer might sell it to smaller dealers at maybe a $5 a coin markup. So small dealer in your hometown is now holding the coins at $42. He's then got to make a markup. So he's likely to make anywhere from 1% to 2%. So if you add that on, by that I mean on the gold price, so anywhere from $15 to $25. So that gets added to the coin. So now a client wanting to buy 2018 Gold Eagles is going to pay retail somewhere around, ballpark, $60 over the gold price.
What's the purpose of that in the sense that gold doesn't spoil like fruit? Why? Who cares what year it is?
Well, that's what we're trying to educate our clients. Now, just to give you an example, backdated Gold Eagles, and they could be 2017s. Some of them are still in the original box from the U.S. Mint. They've never been opened. These coins retail out for as low as $29, $32, depending on the dealer. So you're saving yourself almost $30 an ounce, or 3%, if you were to just buy backdated Eagles as opposed to current dated Eagles. But there is a market that wants current dated Eagles. Don't ask me why. It's not logical from an investment perspective. You have a situation where a lot of this secondary product, now remember, between 2008 and 2011, there were huge amounts of physical material sold into the North American market. Huge amounts of gold and silver eagles, maple leafs, buffaloes to some extent, just a massive amount of gold and silver came into the market between the 2008-2011 cycle. Now, a lot of this gold is still out there. So you have clients that are basically just getting tired. They're saying, everybody's telling me gold's going to 20,000. It's not doing anything. And, the last 2 years has been trading in a $200 range. It's awful boring. And look at my neighbor who's making money in the stock market, or my kid making money in Bitcoin, and I'm sitting here on gold. They're starting to lose interest, and they're selling it back. There's so much of this stuff coming back into the market that the dealers are buying it in some cases at a discount to market. So now they can go and offer this secondary product. By secondary, I mean not current year, at prices 50% cheaper than current year. So from an investor's perspective, if you're looking to buy an Eagle, you're not going to get a premium this low, probably ever again. At that for an Eagle. That doesn't mean gold price might not go lower. But if you're looking to buy gold and you've considered physical, there are some great products in the market right now at very, very inexpensive premiums.
That seems to make total sense to me. I noticed you didn't mention Krugerrands. Are Krugerrands kind of out of favor these days?
No, in Canada, again, they are. And the reason they are in Canada is because they're a 22 karat coin and they're taxable. So Canadians tend not to buy them. In the U.S., there's a good two-way market in Krugerrands. They've been around forever. I mean, there was a period of time in the 80s when the U.S. banned the importation of Krugerrands and the premium on the coins went up substantially, but that's all been lifted. One interesting story on the Krugerrand is that although they came up with a proof-like version for their 50th anniversary last year, they are contemplating coming up with a bullion Krugerrand silver coin, which will compete with the Eagle and the silver maple leaf. And that coin will be tax exempt in Canada because it carries a 3/9 minimum purity. So that would be a product that is looking to come out. Again, the estimated time for that to hit the market is somewhere mid-July, but none of the dealers have been notified as to the premium and or the actual release date. But again, it'll be a new product for the market in silver.
How do you know if the coin that you're buying is real?
We have two options. You can come to us and you can say, look, I want to buy current year 2018, whatever product that we carry that is mint direct. And these coins come directly, let's say it's a maple leaf, from the Royal Canadian Mint, mint sealed strap boxes. These coins have never been circulated. Then you have secondary product. Now, in the secondary product, we have a 3-part testing protocol. We also have a melt procedure on a percentage. We guarantee everything that we buy that we resell. If there's anything that's nicked or not for proper resale, and that will happen at times with a maple leaf and a buffalo because they're 4/9 gold, it's pure, it's almost 24 carats, so they're softer than the eagle. But as far as the eagle goes, we verify each individual coin. We had 4,000 coins come in today. Our testing protocol is not just to count the coins and then test the odd tube. It's to test each of the 4,000 coins. So we test absolutely every unit that comes into our system.
Is that standard procedure everywhere, or is that what you do?
That's what I do. That's what we do. I mean, we have a reputation that goes back to 1978, and the biggest reputation for a dealer is you stand behind your product. Before I send anything out the door, I want to make sure what I'm sending is real.
I mean, that's one of the concerns you always have. Is it real? Is it not?
Go to a reputable dealer. I mean, they're out there, and one that'll stand behind your product, the product that they sell. One of the things I would tell investors to avoid buying, Kitco was guilty of that as well back in the 2000s. Dealers that go on, and again, my boss might not like this comment, but sort of go on a bit of an ego trip and say it'd be kind of cool to produce a bar with our name on it. It's the worst investment you can think of, and only from the context of liquidity. It doesn't mean that the product is bad. It's still 3/9 silver or 4/9 gold. But, pick a dealer, ABC company, that's got a 1-ounce gold round out there, or, a 10-ounce silver bar, whatever. And on the front of it, they've got ABC logo on it. Well, if that client then wants to sell the product, every other dealer is going to discount that product because they're going to have to melt it. No dealer is going to buy that other dealer's product and resell it to their clients. So the retail investor that's bought that product is stuck having to sell it back to the dealer they bought it from,
who can then, in some senses, control the spread of the difference.
Maybe the dealer's not in business anymore. And then basically what do? Then any other dealer that buys it is going to buy it at a discount because that goes into the scrap heap and gets melted.
So how much of a loss is there if you were to buy 22 karat gold jewelry? That would clearly go as scrap heap, I guess. How much of a spread is there between that and the gold price?
Oh, huge. My mother used to be a jeweler. She worked out of our basement putting little studs together and little cages made out of 14 karat gold where a pearl would go in and you'd get a little chain and hang it on your neck. My mother used to make that in our basement, believe it or not. She would sell it to a dealer who would then sell it to a Walmart type of, maybe not Walmart, maybe a higher scale, maybe a Macy's type of company. What my mother got for the piece, just pick a number, $40. Her guy that had connections with the Macy's, sold it for $200, and Macy's put $400 markup on it. Bought something that had an intrinsic value of $40 that you paid, $400 because you're paying for the work.
If you buy machine-made Indian jewelry, the making charges tend to be very low. I'm just wondering how much you give up on the sell side there if you haven't paid much over the spot price with making charges.
Well, you're definitely going to pay over spot,
right?
Number one. But if you're not, then basically, and we're talking. What are you trying to compare? A 22 karat jewelry?
22 karat jewelry versus, say, an American Eagle. How much of a discount does the 22 karat jewelry go?
22 karat jewelry, if it's retail, again, depending where you go with this. I mean, if you go to one of these, we buy gold things that are sort of attached to a mall.
Well, there you're not going to get a deal, right?
Oh, but I mean, again, if you're just an individual that's got, 5 grams of this, a big dealer won't even touch it. So you're kind of stuck going to a smaller dealer. I'm guessing you're going to get a 20% discount to gold.
Okay.
Whereas an American Eagle, depending on demand supply, will go anywhere from flat bid to a $10 premium.
You even get a premium on selling the Eagle back. Okay, I didn't realize that.
Yeah, it depends. Again, it depends on supply and demand. Right now, we're looking for backdated Eagles. I think we're bidding $5 premium. And we're looking for backdated, we just picked up some Buffaloes today. But we're, I think, right now paying $5 premiums on both Maple Eagles and Buffaloes. One of them will be a $10 premium, but they're at least $5 premiums for those three coins. There are dealers that are still paying $10 discounts on those coins. And that also has to do with the size of the dealer, because you have to understand, if you buy these coins, the client that's selling them to you wants their money. So now you've got carry cost, capital cost, and you've got inventory that you've got to turn over. So the smaller dealers that don't have capital to be able to handle those types of transactions tend to discount them more. And, if they can't sell them retail very quickly, they'll sell them out to a wholesaler and still make their profit.
That makes total sense. So last question along the lines is, what are your thoughts on the future of gold prices? It's been sitting in a range for quite a while, and half of the people say it's going up, the other half say it's going down.
Well, I've been happy with it because I look at the gold market and, my responsibility at Kitco, and also when I write my blog in the morning, it's intended to be written for the eyes of traders, not for the general investor that is just looking to, hold gold for a long-term play. I've been very happy with this gold market because one thing it has given over the past year is a lot of volatility. To a gold dealer, volatility is exactly what you're looking for, up or down. We've been constructive. We were very constructive gold back in December of 2017 when the Fed moved. We said the minute the Fed moves, I'd buy gold. I think we picked it up at $1,245. So right now it doesn't look that good, but trust me, that position has been long turned over. When gold did finally start to rally, and we expected the rally, once it got over 1,300, we were looking, and I've probably written 20 blogs on this, we were looking for a level that it needed to break up through, and that was 1,365. It hit that level once in 2015 and once in 2016, and it hit it twice this year. Every time it got 1,365, it backed away. And we then turned bearish on the market. We said, look, take the money off the table here from a trade perspective. If it gets through 1,365, it's probably got another $80 on the upside, because there was, from that chart level to 1,425, there was nothing. There was just air. We figured 1,365, positive close there, would see 14 and a quarter. So we took our money off the table at 1,358. Subsequent to that, the market dropped all the way down to 1,310. We again became constructive. About 2 weeks ago, when gold was having trouble getting up through the 1,337 level, it was really running into resistance there. We suggested to pull back again until that level was cleared. We've been on both sides of this market. Now, if you're asking me from a longer, again, I hate saying the word longer term, because, what does that mean? If you're asking me from a perspective of, do I see value in gold here? I see more value in silver at these levels, but gold at these levels, I think has got some downside risk as long as the dollar keeps on its upward trajectory. But downside risk to me is maybe 12.20. I'm thinking 12.50 will hold. And then seeing everything else that I'm seeing developing in the market, unless things radically shift in Washington, there's a lot more risk out there than I think the market is pricing in. So I would still be constructive on the gold market for the group of investors that are looking for, obviously, insurance, and or the investors that believe the system might collapse.
Well, thank you for sharing that. I think we've covered a lot, and you've done an excellent job of educating us on gold. Is there anything else that we should cover on this topic that we missed?
For long-term holders here, you might want to consider silver. First of all, it's trading at $16.30. I know it's been boring. You can take the other side here. And the other side of this is, let's assume the economy just booms and everything works out. You can hear by the way I'm saying it that I have some skepticism, but let's just assume that happens. And Trump gets his 4% GDP and interest rates go to 5 or 6%. I mean, the global economies will be humming, and industrial demand for silver will start to pick up dramatically. In that context, I can envision a situation where gold doesn't do much, but silver actually outperforms to the upside. With silver, I think you have a dual-sided hedge. If everything collapses from an economics perspective, gold's going to take off and silver's going to go up with sympathy. It just will. I mean, that's just the way they trade. And if everything is really great, silver might still do okay. So of the two metals, I'd be looking at silver at this level.
Well, thank you for sharing that. If people want to learn more and read your blog and hear your commentary, what's the best way for them to find you and get all that information?
Well, Kitco.com. I just wanted to make one comment on Kitco. And again, you might have discerned this from my conversation with you today. I don't like blowing horns or promoting anything specific. But I have to tell you, having been in this business as long as I have, Kitco is very unique in one sense to almost any other dealer that is in the business. And that's that on our site, Kitco.com, we publish articles every day. Some are bullish, some are bearish, some are technical in nature. It is an excellent ground for people to understand why things are happening in the market and get some education on the precious metals market. If we were a dealer saying, buy gold, because that's what we do, every commentary would be bullish, and that's absolutely not true. So we have a very, very strong Chinese wall between our media division and our trading division. That would be a place that I would recommend people go and read. They might find an analyst or a talking head that they feel comfortable with and makes sense for them, and then they can follow their guidance accordingly. But at least they'll have the ability of learning about the market before they make their decisions.
I advise people, if you're going to get involved in this, be intentional, know what you're getting involved in, do the research, see how it fits into your portfolio, and then decide what type of an investor you are and what your entry and exit strategy are. That's the best way to invest, and I think that's kind of what the information that you started out with, how you teach your kids, and I think that's a great way to bring it back full circle. Thank you so much for joining us today. It was a pleasure to have you.
That was my pleasure, Rocky.
If you're at the point where you need to create a hedge against your portfolio or want to diversify, gold may be a great option. As I record the closing of this episode, which is about a month after the original recording, gold prices have dropped considerably. You never know what the market is going to do. I'm waiting for gold to break out in some way, either up or down, or for some other signal to make a move. I hope you enjoyed the education of today's episode, and remember, this is informational only, and you need to consult with a professional for your specific needs. Today's action step: consider if gold or silver is something you should consider as part of your wealth plan. It's harder to keep wealth than to make it. Once you come up with a system to create wealth, you need to come up with a system to keep it. If you'd like a second opinion on your financial plans or are worried you're missing something, check out the SWOT analysis, strengths, weaknesses, opportunities, and threats at richersoul.com/SWOT. Is there someone you know who could benefit from what we talked about today? Please share, as it helps you to build social capital and create better relationships and start better conversations with the people you know. They'll appreciate you for it. Remember, we talked about that during the opening. What's preventing you from moving forward, and who are you putting on your team to help you build the life you deserve? Taking no action creates a far worse outcome in life than trying something and failing. You can get me at rocky@richersoul.com. I'd love to hear how you're doing and how the information I've shared has helped you. Thanks for listening. Have an abundant week.